Okay, good afternoon and welcome back everyone to part 3 of our beginners options master course. Today what we're going to do is we're going to take everything we've learned over the last few weeks and apply it to the current markets. And what I'll do is during these very volatile times, I know many investors are trying to answer the question as to how do you go about proceeding in this market? Where do you invest? How do you invest? I want to try to provide some context into the research that we're currently looking at to gauge our directional view. And at the same time, taking what we've learned over the last few weeks and show you how we can apply them to the markets right now. Despite the current volatility, which certainly makes it challenging to trade, I actually find this volatility to be a good teaching moment from the perspective of it exacerbates some of the things that we've been teaching over the last few weeks in terms of volatility and provides an extreme example to show you how options can be leveraged in this type of volatile environment. And how do you go about positioning yourself in the long run for the eventual recovery of whether it's the Canadian markets, global markets, or whatever markets that you trade, utilizing options. So let's go ahead and get started. I have a lot to cover with you here today, but before I do, just a quick disclaimer. Any trades that I'll be talking about here today are purely for demonstration purposes. They are not a recommendation by OptionsPlay or a solicitation to buy or sell any specific securities. And for those of you that are brand new to OptionsPlay, what I will be showing you is a platform that is available to everyone in Canada completely free of charge. OptionsPlay Canada, courtesy of the Montreal Exchange. You get access to the platform that I'll be showing you here today, and I've just posted a link into the chat window for those of you that do not already have access to this to be able to log in and register, which gives you access to bi-weekly options educational webinars like the one you are on here today, free on-demand video library so that you can view all of our previously recorded courses, and lastly, a weekly cover call and short put report so that you can implement strategies like cover calls and short puts in this type of market environment, which are some strategies that we'll actually talk a little bit about here today. So a lot of different resources available to you free of charge. You can sign up using that link if you have not already done so. So today, this is part 3 of our first beginners options master course. What we've learned about the first in part 1 and part 2 is really the benefit of options, meaning if you took the time to learn how to trade options, which many times can take a few weeks to a few months, giving you a bit of a fast forward, seeing if you went through all the options education, what you would be able to get out of it. Last week, what we did is we covered the difference between buying versus selling options. And today, what we're going to do is we're going to take everything we learned in part 1 and part 2 and apply it to some real examples that I have to show you guys here today with the current markets. So, and because of the current volatility that we're currently in, what I'm going to add to this is I'm going to start off by talking a little bit about the market outlook, just giving you a broad-based, high-level understanding as to how a strategist like myself is currently viewing the markets, what type of research I'm looking at to gauge my directional view. And then what I'll do is I have a real example of a stock that from my perspective is worthwhile looking at from an options. And I think it's a great teaching moment to apply what we learned last week to the current markets. And then what we'll do is we'll allow you guys to submit some symbols that you want to take a look at, as well as your outlook, so that we can see how we can apply that to the current market. And then at the end, what we'll do is we'll do a little bit of Q&A. And so that's what we're going to cover here today. But we do have a lot of things coming up in April. So for those of you that have joined us in March, I really encourage you to continue your options education with us in April. For those of you that are just joining us for the first time today, you can catch up on part 1 and part 2 for recordings, but I highly recommend you to continue your education in April with us. We're going to be covering 2 very practical approaches to what we've learned in the Beginners Options Master course. First of all, what we're going to do is we're going to look at adding yield to your portfolio. This is really the first step in looking at an actual strategy that you can apply to your portfolio from what we've learned from selling option strategies. And then what we're going to do is looking at adding leverage to your portfolio utilizing options, which is more along the lines of buying options. So we're really going to take a much more practical approach to strategies that you can implement in your portfolios on April 6th and April 14th, selling and buying options. And then what we have for the first time is a virtual options education day. I know many of you that are joining me here today may have attended an options education day in the previous years in one of the select cities of Toronto, Montreal, Vancouver, or Calgary. Because of the coronavirus, because we want to be able to reach more of you, we're doing a virtual options education day, which is available to everyone across the whole country, and it's going to be a similar type format, and we're going to do it during the trading day. And we're doing it during the trading day so that we can do some live examples with you. We have a great speaker lineup for that we've already put together for April 27th. You're going to start getting emails later this week on how to register, but I do have a preview. You can register using this link, trade.optionsplay.com/VOED2020. I will post this link into the chat window for everyone who wants to sign up for that if you would like to. This is a great way for you to learn to trade from the pros. And what we're going to do is, this is really going to be live trading. We're going to try to go through examples of the current market. This is going to be during the trading day so that you can watch pros see how we apply our trading to the real markets. And then you can ask questions and provide some ideas and thoughts around your trading, and we'll answer your questions live. So really excited to have everyone available, everyone join us on April 27th for our first virtual options education day. So a lot to cover here today. I'm going to first start off by just taking a quick look at the live market outlook and providing some live analysis on the current markets with a symbol that I have in mind that I think many of you probably have either in your portfolio or are thinking about adding to your portfolio at this time. So I'm going to go over that first, and then what I'll do is I'll make sure that I put everything in the context of what we learned last week, which is the difference between buying calls, selling puts, buying puts, and selling calls. So last week we learned that buying calls and selling puts are bullish strategies, and buying puts and selling calls are bearish strategies. We're going to really take all of this together into a single strategy today. And for those of you that are brand new to options trading, if you feel that you're still catching up, feel free to watch part 1 and part 2 again before you come back and watch the recording of part 3. But this is really designed to make your understanding of options as intuitive as possible and based on real symbols so that you have a real grasp as to what we're teaching you here today. And lastly, what I want to do is touch up on call put pricing, meaning how much are you actually paying for calls and puts, to give you an understanding as to the cheapness or the expensiveness of options and how you can use that to your advantage in this current market. So I'm going to cover a lot of different things, but I'll start off by just talking a little bit about the current market outlook. If you look at XIU, which is the S&P TSX 60 index ETF, we've had a pretty dramatic downfall from about 27 bucks down to just shy of $17. And you had roughly a third of a retracement back to its highs. And we've recently come back to, I would say, a bit of an equilibrium state, if you will. Basically, what we saw is during the sell-off, I would say that most investors were in agreement that everyone was selling. There was some buyers, very short term, that tried to buy the dip, but those all failed, and we crashed almost 40% here, roughly 40% here on the TSX 60 index. It's rallied back up, on the stimulus package that the U.S. has put out. Canada has followed through with similar type of fiscal and monetary policy. And ever since that's happened, the market has really, for the most part, have moved mostly sideways here. So we were trading here last Tuesday. We're still here roughly and that same level around $19. So what we're really looking for here is an understanding as to where this market can go. And I will say that if you look at a longer term chart, $21 here is a major support level that I see on the TSX, on XIU. You certainly do have some support, but I do think that some of the support levels that we're currently looking at perhaps overshot things a little bit to the downside. But, you know, if we look at the December 2016 lows or the January 2016 lows, that sits at around $17 or so. So what you basically have here is a bit of a neutral zone here between about 21 and $17 or so. We're kind of in this neutral zone, and I would expect that over the next few months, this market can trade fairly in a fairly volatile range, because we still expect volatility to be pretty high, but somewhere at this point between 21 and 17. If the market breaks out above 21, that would certainly for me be more of a bullish stance on the markets, meaning we return back to more of a bullish view. But until it breaks above 21, I would hold off on taking on any really bullish views per se. But I do also expect that, you know, given the current trends that we're seeing out of the coronavirus, and I have some data to share with you on that front as well, the coronavirus trends right now do not look particularly great. So, you know, we have China and South Korea, for the most part, that has been able to decrease the number of daily new cases substantially. Really, the only two countries that have been able to do this are China and South Korea. Every other country is still at this point behind the curve. Italy is starting to flatten out, as you can see here. Usually what we're looking for is an exponential growth that ends up tapering off. Italy hasn't exactly tapered off, but at least it's not growing in new cases. And out of all the countries, all the, I would say, democratic countries, Italy has taken probably one of the most draconian measures in terms of locking down their country, locking down their state to try to contain this virus, of which the US is certainly behind the curve on that, has not taken the same level of draconian measures to try to lock down their citizens. But, you know, in places that are heavily affected, such as New York City, where I live, things are pretty quiet. People are, generally speaking, staying indoors. And I hope everyone here also on this call is staying at home, staying safe, and doing our part in trying to contain this virus, because what we really don't want to see is are cases like the US where it grows uncontrollably, because that's really the concern that we have here. The longer this exponential growth continues, the longer the recovery is going to take, the longer the economy is going to be affected negatively. And right now, I think the magnitude is less a concern for us from a market perspective. I think the duration is probably the biggest concern. I think for the most part, between looking at Italy, between looking at China, looking at other countries like Spain, which also has had multiple days of no new increases in new cases, what we do is we have a pretty good understanding as to the magnitude of the coronavirus. What we don't have a good understanding is the duration. And that was where I see the true downside risks to all of this. If you look at most research, we're all pointing at this point towards a Q3, Q4 recovery back to positive growth in our economies. And I think that that's really where we see, at least from my perspective, I see some downside risks. Meaning, if everything goes well, I would agree with those types of estimates. But I think that there's potentially more, there's potentially the possibility that some governments, maybe not Canada, maybe not US, but other global governments around the world that may not take this as seriously, that may not be able to control this as well as maybe some of the developed countries, that will have ramifications on our global economy. If we're not able to get back to trade, if we're not able to get back to air travel, I think there are some major ramifications, and those are the downside risks that I currently see. But I certainly think that things have kept to what I would consider a bit of an equilibrium now between, again, this $21 level and the $17. I expect things to be fairly volatile within this range, but until it breaks out above 21 or below 17, I would say that the markets are currently in more of a neutral and more of an equilibrium state. So what that means is that I think that there is an opportunity to potentially look at some opportunities to go long, and I have some examples here of how I would go about looking at the markets and how I would position myself utilizing options. And the thing that we want to put into that we want to try to remember and put this into the context of is really what we learned over the last few days. So the first symbol that I'll point us to is BMO. And I'm using BMO as pretty much a proxy for most Canadian banks at this point. I know most of you, most Canadians invest in some shape or form, some of the Canadian banks. These are the options that typically tend to be the most liquid, because in Canada, you really have three main sectors. You have oil and gas, which I'll be perfectly honest, with oil prices declining further today, I really think that it's difficult to continue to invest in oil and gas at this point. I think there's going to be further downside. I think there's going to be further pain in the energy markets. That's my personal opinion. So I certainly am not looking for investments in that particular sector, even though dividend yields in that particular sector is extremely high. I think that sector is damaged, and I think there's going to be further pain. But the banking sector also currently is yielding some pretty high yields, roughly 6%. And I think this is the average Canadian bank right now. BMO is at 6.1%, but they're far better capitalized than the oil and gas companies. And the Canadian government support package, I think, is far more conducive in making sure that the Canadian banks stay afloat. Most of these Canadian banks are pretty much trading at pretty much at book value or just slightly above book value. And just to put that into context, when BMO is trading around $100, is trading at around 1.5 times book value. So you're talking about a 30% discount from a valuations perspective. And trading at 6.1% dividend yield, I think this makes it an attractive place to potentially park some of your capital if you think that the markets are going to recover by Q3 and Q4. So what I want to do is I want to show you how we can utilize options to take that view while doing so in a way that protects us if this market continues to erode significantly lower. So what I want to do is I want to take a look at a bullish view. Now, before I do want to do a quick poll here. Now, if everyone can please pull up your chat window at the bottom of your screen. I just gave you my thought on where I think the markets are going to go. I'm curious to hear what you guys think. So if everyone could bring up the chat window, and if everyone could just kind of, let's look at 1 month. Does anyone here, you can either type in up or down, where you think the market's going to be 1 month from now, either up or down 1 month from now. Okay, it looks like looks like a vast majority of you think the market's gonna be down 1 month from now. Interesting, okay. And just out of curiosity, the same question, where do you think markets will be 1 year from, at the end of this year, at the end of 2020, up or down? Interesting, so most of you now all of a sudden shifted to, I would say, up. Okay, very, very interesting. So a lot of the consensus, at least here for the group, is that in the next month, you expect the markets are going to keep moving lower. And most of you expect that by the end of the year, the markets will be up. So here's my view as far as looking at a stock like BMO is more for the long term. You can certainly trade for the short term, but options are extremely expensive. And we'll talk a little bit about that in 1 second. But I want to show you some of the thoughts that I have here. So I'm thinking that with 6% yield on a banking stock where we have government support in these stocks, that there's going to be somewhat limited downside to these stocks. And the 6% yield, I think, is one of the more attractive places to park your capital. It could certainly perhaps more attractive than perhaps some of the fixed income products right now out there. So what I wanted to take a look at is showing you buying a long-term option. So I'm going out to January, and let's say I look at a I'm going to start off by looking at a $60 call option. So as you can see, the $60 call option currently costs $12.50 for a $67 stock. So, and I want to put this into context for you. Actually, before I do, let's back up 1 second. Let's look at the whole market for 1 second. Let's say I wanted to buy, and since most of you said that by the end of the year you expect that the markets will be higher. So let's say I look at maybe a March 2021, so a year from now, I buy a $19 call option that costs $2.82. What I want to do is I want to first provide some context as to what that actually means to pay $2.82 to buy a March at the money call option on the S&P TSX Composite Index ETF. So the composite ETF is currently trading at $19.80. The call option out to March 2020, 1 full year out, costs $2.82. What that means is I'm paying 14% of the underlying stock price to buy an option that allows me to purchase this ETF at $19 by March. Meaning if the market is back up to 25, 26, I'm able to buy my stock for $19. I pay $2.82 for that option. And as long as the stock is above $21.82 by March 19th, I would break even on this particular trade. Now, $21.82 is where it was trading back on March 11th. So the question you have to ask yourself is, do I think 1 year from today, do I think the markets are going to be up by that amount or higher in order for it to make sense to buy that call option? This is something that we covered on our webinar last week, was really taking a look at not only when we buy a call option do we have to be bullish, but bullish by what amount? And that amount depends on the value of that call option. In this particular case, it's $2.82. And many times, it's better to think about them in the context of what percentage is that of the underlying stock price. So basically, this is saying the stock has to move up roughly 15% in order for it to make sense for you to buy this call option. And you can think of it in those particular terms, right? So let's take a look at BMO, okay? Now, BMO is a little different because this is going out to January. Let's see if we can even look at, so the closest option I can find is February. So let's use February for, unfortunately in February, there aren't options listed for those strike prices. So let's go to January. Let's say I'm looking at a $66 call option, which is roughly the at the money call option. This costs $9. So let's put us in also the same context again. So BMO, current price is $67.46. The call option is $9. And the reason that we care about the price of the call option is because buying the call option is not just a bullish strategy, it's bullish by a certain amount. And that amount depends on how much does the call option cost. So it's important for us to know how much are we paying for our call option. In this particular case, notice how buying a $9 call option on a $67 stock equates to about a 13% cost of the underlying stock price. Now, if you looked at these numbers 2 months ago, before this whole volatility sell-off, this number, if you went out a year out, probably would have cost you maybe 5 or 6%. But because of the new volatility environment that we're in, it's costing you substantially more, okay? But, a lot of times, many people will say, wow, that's really expensive. But then if you ask yourself, well, okay, going a year out, knowing what we know, so many of you answer that you think this market's going to be higher 1 year from today. If the break-even price of this call option is $75, meaning you have to believe that the BMO will be back above $75 by January 2021. Now, $75 is where it was trading on March 10th, right? So could it break back above 75 by the end of next year? I certainly think that for many people, that's a possibility. And the reason that you might want to consider taking a look at this type of strategy versus buying the stock itself is because so many of you had said that you believe that the markets may still be down in the next few months. And just maybe this continues to get worse, right? That's always a possibility. And I don't necessarily want to be a pessimist here, but I want to suggest that, what if things do get worse? What if this goes back below that $55 level and keeps moving lower, right? What happens if by the end of this year or towards the end of this year, the markets do not recover as we expected to, and markets continue to move lower? I always want to know, what is my worst case scenario and what am I risking? So in this particular case, if I bought the $66 call option versus buying the stock, no, if I bought 100 shares of the stock and the market continues to deteriorate, I'm risking $2,200 if the markets deteriorate down to $45. If I buy this call option, I'm only risking $877. So the goal here is to still try to get the same upside while limiting my losses to the downside. That's why we buy call options. And what we want to do is also want to know, based on our P&L calculations, well, what happens if we do get this rally at the end of the year that many of you suggest that this is going to, that we do get a rally? You want to see, well, how much profit do I actually receive? If you bought the stock, you have a very nice 33% return, which for many stock investors is certainly a good return for your money. But looking at that call option, you're looking at $156% return on your capital. So the goal here, from my perspective, especially in these volatile times, is to try to invest with the least amount of risk while still participating in the upside. And that's why we want to buy call options. But what I want to do is I want to show you one step further, right? So first of all, what we learned is that buying a call option allows us to take that long-term view in this particular stock, do so in a way with relatively limited risk. And I also even want to take a look at perhaps, I want to even look at buying a slightly in the money option. So buying a slightly in the money option will cost me a little bit more, but my break-even price actually improves, because when you buy an in the money option, the call options are more expensive, but you're actually paying less in extrinsic value. So now you have the break-even price is $72.50, which means that the stock only has to move $5 higher, but by January 2021, in order for this call option to be profitable. And this is really where you can play around with the different options, strikes and expiration dates, to play around and see where your break-even price, where you think the stock's gonna go, and see how you can utilize options to your advantage. But today what I wanna do is I wanna show you, even take this one step further, okay? So during last week, we learned about buying a call option is a bullish by a certain amount strategy, but we also learned about selling calls, somewhat bearish but not too much, or somewhat neutral, right? So I think many of you, since so many of you have answered that, in the next month, you actually expect the markets to move lower. So how can you use that to your advantage? What you can do is you can buy this January $60 call option for $12.50 and express your long-term bullish view. But what you can also do at the same time is you can express a short-term neutral or perhaps even bearish view. So what you can do is you actually sell a short-term option. Let's say in this particular case, I sell a $72 call option. So I pay $12.20 for the $60 call option. But then what I do is I sell a $72 call option against the long call. And this allows you to further reduce the cost of your long call. So here I'm paying $12.20, which is, what did we say that amount was? So let's change this to $12.20. So now I'm paying 18% of the underlying stock price to take this long-term view. But if I sold the short-term call against it, which is a short-term bearish or short-term neutral view, I can collect $1.20, which actually means that I bring the total cost down from $12.20 down to $11.00. So imagine if I was able to reduce my cost from $12.20 to $11.00. Now I've reduced my risk from 18% to 16% of the underlying stock price. So the stock doesn't have to move as far. And this is really where you can truly fully utilize the value of options. Now, this may be an advanced strategy for some of you that are brand new, but for those of you that have already traded these types of spreads or multi-leg strategies, this is how you can fully utilize the extreme volatility these days to offset the cost of the long-term options, the more expensive long-term options that you can buy. And for those of you that are brand new to options trading, this is designed to give you a glimpse into the power of options and show you a way to utilize options that you may not have thought of previous to taking this course, because there's so many different ways that you can utilize options. And that's really why we spent last week breaking down these 4 strategies, because all complex option strategies are based on these 4 fundamental building blocks. What I'm really doing is I'm just merging some of these building blocks together to create the maximum upside for myself while minimizing my downside. So what I've done here is I've reduced my total risk from $1,220 down to $1,100. And the goal here is that if you look at my long-term chart, we said that here $72 is that resistance level. So what I'm basically saying is that in the short run, I think that this market is going to be relatively sideways. So if I sell this $72 call option and the stock doesn't exceed $72, I keep my $1.20, which offsets the cost of buying that $60 call option. And what I'm expecting is that in the short run, the markets will move somewhat sideways, but in the long run, I think the market's going to move higher. So what I can do is by April, I can sell the $72 call option, maybe collect $1.20. And then if that by April 17th, the stock stays below 72 and I keep that my $1.20, maybe at that point, what I'll do is I'll roll that out to May. And I'll sell another call option in May. Now, I wouldn't get $2.45. I might get maybe another $1.20 or $1.50. And you might want to change your strike prices by then, depending on whether the stock is higher or lower. If the market is lower at that point, maybe you sell a lower call. Maybe you sell a $66 or $64 or $68 call option. It really just depends on where the markets expire at the end of the April expiration. But the goal is that you keep your $60 call option, you keep your long-term bullish view, but as the market progresses in the short run, as long as you maintain your short-term bearish or short-term neutral view, you continue to sell call options against your long call that will continuously reduce the cost of your long call. And if you're able to do that for even just, let's say, a couple of months, because that's when you think the markets are going to be somewhat neutral, then what you do is you're able to reduce your cost of your call from $12.20 to $11 to maybe $10 to maybe $9 by the time you're finished selling these call options. And now, as you can see, you've reduced the amount that you're paying for that call option by a fairly significant amount, which reduces your total risk, right? Because originally, you were paying $12.20, which means that you're risking 18% of the underlying stock price to take this long-term bullish view. By the time you're done with this, you're only risking 13%. And the goal is to try to maintain your upside exposure, right? Your unlimited upside exposure, while doing so in a way where you risk the least amount of money. At first, you were risking $12. Now, by the end of selling multiple calls against it, you might reduce that cost down to maybe $9 or $8. The lower you reduce your risk, the higher your returns are, and the better the break-even price on the underlying stock. So when I started this off, before I sold this call option, my break-even was $72.20. But by selling that one April call against it, that April $72 call option, I've already reduced my break-even price down from $72.50 down to $71 just by reducing the cost of the underlying trade. So this is one way of how you can really utilize options to your full advantage by buying your long-term view using a call option and selling a call to express your short-term bearish or short-term neutral view that many of you have said here in the beginning of this example. Now, I know I went over a lot here, but I did want to make sure that I took a very deep dive into this one specific example to show you a real example of how I would apply what I taught you last week here to the real markets in a real example. So before we kind of continue on, I just want to make sure everyone understood what I just explained here. So please type 2 into the chat window if you feel that you understood what the example that I just expressed here on BMO. Okay, perfect. I see a lot of 2s. Great. So with that, what I'll do is I'll open this up for any examples that you guys want to take a look at, meaning you can throw out a symbol, and please also at the same time express what whether you're bullish or bearish on that underlying stock. And let's take a look at some examples together and how you can utilize options for this. So please also put in whether you're bullish or bearish. So Wallace wants to take a look at CM, and Wallace is bearish in this particular example. Whoops. Canadian Imperial Bank. So Canadian Imperial Bank has a very similar, from a fundamentals perspective, similar to the Bank of Montreal. Let's see. All right, Canadian Imperial Bank trading at $78, 9.1% in dividend yield, substantially higher yield. But Wallace wants to take a look at bearish view. So let's take a look at a bearish view, right? So, I don't know how bearish you are in terms of what time frame, but let's say, maybe out to July or August, maybe is your bearish view here. Now, let's just take a look. The current stock is trading at $78. So the at the money option is the $78 option that costs $7.90. And let's just put this again into context, right? Now, this is a little different because we're comparing in this particular case, roughly a 3-month option. But what's interesting here is that even a 3-month option is still costing you 10% of the underlying stock price. In the previous 2 examples that I was looking at here, we're looking at roughly 1-year options. So the 1-year option was about 3 to 4% more expensive than here in the 3-month option. So these options are pretty expensive, meaning that by July, to buy the $78 put, the stock has to be below $70, which means that it has to basically get to a brand new 52-week low just to break even. So put that into context. You would need a decent move to the downside, meaning things have to get materially worse than what we saw last Tuesday, which, if you think about it, was prior to a lot of the fiscal and monetary policies stepping in. Meaning we have to have an outlook that's more bearish than what we saw last Tuesday. Not sure that's going to happen, but things are changing very, very quickly. What I said, 2 weeks ago doesn't really apply, anymore. So what I'm saying today may be completely out the window 2 weeks from today. So anything can happen in this particular market, but it's important to remember and think about these options in the context of what percentage of the underlying stock price are you paying? Because in the next 3 months, CM has to move 10% lower just for you to break even. So you have to ask yourself, do I think CM is going to go below $70.10 or roughly $70 by July? Because if you do, you have to ask yourself how much, right? How much further do you think the stock can go? Maybe you think it'll go to 64, right? So you can ask yourself, well, what happens if the stock goes down to $64 by July? You would be looking at about a 77% return. And keep in mind that a $64 move to the downside is almost a 20% move to the downside. That's not a small feat. So you basically have to have a 20% move to the downside just to make 77% return. That, in my opinion, isn't that great of a view. So you can certainly take a look at that, but you can also at the same time maybe sell a short-term put against it. Maybe you think in the short term that it won't go below maybe 70 or 72. So what you can do is you can maybe sell a short-term put against it, collect $1.22, which would reduce your cost down to $6.68, which would certainly go and offset it a little bit, $6.68. Now you're only risking 8.5% of the underlying stock price. Not a big improvement, but certainly a small improvement here towards your view. So that's how I think I would look at Canadian Imperial Bank. Mark said an interesting comment here about selling credit spreads. That I actually think also is a viable way to potentially play this. This is getting ahead of the curve because we haven't talked about credit spreads. We have not discussed them, but credit spreads is another strategy that you can take that is similar to selling a call option. But what you're doing is when you're selling a naked call option, you have unlimited risk, and we usually don't like to take unlimited risk. So what you can do is you can sell an at-the-money call option and then buy an out-of-the-money call option to offset your unlimited risk. Because as we learned a couple of weeks ago, when you sell a call option, you have unlimited risk to the downside, and no one wants to take that unlimited risk factor. So what you can do is you can combine selling a call with buying a call, so that what you do is you reduce your downside risk so that you have a capped amount of risk to the downside. So this is another strategy that you can take, where basically what you do is you sell a $78 call option, collect $5.45, and then what you do is you buy a higher call option, paying here in this particular case $2.11, and what you effectively end up with is a max reward of $334 and a max risk of $466, and your break-even price here is $81.34. So as long as the stock stays below $81.34, which is the level that I have highlighted here on my screen, then what you do is you collect 300, you're profitable. If the stock goes above 81.34, that's when you start potentially losing money on this particular trade. So basically this trade is suitable if you think that the markets are going to move a little bit lower, but not too much, meaning buying a put option maybe is too expensive, meaning the put option needs to go all the way down here for you to make money. And maybe you just simply think that it's not going to go that far. So what you can do is you can sell a call vertical or credit spread to capitalize as long as the stock doesn't move substantially higher. So when we talk about selling a call option is somewhat bearish, but not too much. This is really the what a credit spread is allowing you to do without taking on the unlimited risk. So thank you for suggesting that, Mark. But again, I will say that I didn't bring this up as a strategy simply because this is a more advanced strategy. It's something we're going to cover in one of our intermediate and advanced courses. And right now we're just talking about a beginner course. So I'm trying to keep things a little bit more manageable, especially for those of you that are brand new to options trading. Let's take a look at this. SU, someone is bullish on SU. Meyer is bullish on SU. Sorry, SU, is that a Canadian symbol? So we're only looking at Canadian symbols here. So I see a lot of US symbols. People are requesting for US symbols. Keep in mind that we're only looking at Canadian symbols here. So TELUS is a one that we're looking to do. TELUS is a telecommunications company. I don't particularly have a strong view on this from the perspective. I do think telecommunications should probably stay relatively stable. I don't have a lot of insights into this particular industry at the moment. So the person who asked for this is bullish on TELUS. So let's take a look at this, right? Let's take a look at a bullish view on TELUS. Let's say we go out to January. So the stock's trading at $21, and let's put this into the context. It's trading at $21.02. Buying a January $21 call is $3.60. So what percentage of the underlying stock? 17%. So far out of all these ones that we've looked at, this is probably one of the most expensive ones outside of the CM one that we were looking at earlier. So 17%, and the reason I'm giving you these numbers is because I want you to think more in terms of not just the dollar amounts, because sometimes the dollar amount might be really low because it's a low price stock. But when we think about it from a percentage perspective, that's when we are able to put these into, in my opinion, more of a context to see, if this, when I'm paying $3.60, that might not sound like a lot of money, but on a $21 stock, that is quite expensive. So what you can do is you can buy that $21 call option, but at the same time, sell a short dated option against it. Maybe in the short run, you think the stock's going to stay below $23 or so. It's not a lot of premium. And this is one of the challenges of trading one of these low price stocks, is that each strike price is a fairly large percentage away from the current price. I do think selling a $22 call option is a little too aggressive. The $23 call option will collect 20 cents, which is roughly 20% of the long call. So, if you're able to reduce your cost from $2.45 down to $2.20, you're now paying 10% on the underlying stock price. So that makes it much more, in my opinion, reasonable to pay, roughly 10% of the underlying stock price to take this long-term bullish view here on TELUS. I'll take a look at a few other examples before we get to CG. So this is I'm presuming this is a gold mining stock. I'm not familiar with this particular company. So this is an $8.63 stock. If we look at a long-term call here for, out to $8, $2.30. Now, this is one where I think it's deceivingly expensive. So $8.63, whoops, CG. $8.63. This cost $2.30. That's 26% of the underlying stock price. So that, in my opinion, is something that's much more expensive than any of the other examples that we've looked at. So be very careful when you're stepping into these types of options. Many times investors that are relatively new to options will see, oh, $2.30, that sounds really cheap compared to BMO. That was $1,000. Why don't I buy this? But they forget to see that, you know, you're paying substantially more, double the amount that you're paying for a BMO call option. So it might sound cheap, but cheap is always relative to the stock price. So be careful. So I would be really careful venturing into a stock like this just because of how expensive those options are. You know, I see a lot of requests for US symbols. I'm not going to take a look at those, but CNQ, Canadian Natural Resources, someone said that they thought this was too beat up and it was going to recover. So let's take a look at that. This is trading at $15.16. Let's go out to January 2020. This is $6.20. So I think this also may fall under that category of very expensive. So $6.20 is 40% of the underlying stock price. This is really the most extreme example that we've seen so far. So be very careful when you venture into this. You know, Gene, who asked for CNQ, you know, these call options, in my opinion, are really too expensive to venture into without finding a good option to sell against it. So if you do think that this is beat up and you are able to sell a short-term option, maybe a $17 or $18 call option, oh, well, let's just back up 1 second. This is something else I want to address, liquidity. So right now, if you look at these options, this is trading at $1.55 by $6.20. What that tells me is that the liquidity on these options are so poor that the spread itself would eat away more than 60–70% of the cost of that call option. So I'd be even more careful about stepping into an option like this, just because I think you're going to have a tough time getting executed on the buy of this call option, and you may have some trouble exiting this trade, even if you are correct on this particular move. So even if CNQ does recover, you might have some trouble selling this call option that you purchased. So I'm glad that you brought up this example, but this is really good in helping us understand what to look for. Not only how much are you paying of the underlying stock price, so even at $3.90, even if you're able to get filled at the mid price, you're still looking at 25% of the underlying stock price. Now, some people might say, well, this stock moved 13% today. I'd gladly pay 25% of the underlying stock price going out a full year, knowing that this stock can move 12, 13, 15% a day. And that very well may be true. So, but as long as you understand the risk that you're taking and understand that $3.90 may sound very little, but it's actually a lot in the context of the underlying stock price, these are the risks that I want to make sure everyone understands, because sometimes the textbooks don't show you this. Sometimes if you just look at the options education, they don't go through these in such a practical way using real examples. And that's why we want to take this time to show you real examples, especially during these volatile times, to show you what to look for when you're thinking about buying that call option. Different, not only looking at the value of the stock versus the value of the call option, also looking at liquidity. These are all really important things to factor into before you go out and buy this individual option. So that's really why we wanted to take the time out here today to give you an outlook as to how we're currently viewing the markets. I think your views as a collective group here aligns with exactly my views, which is in the short run, we're more neutral, perhaps even a little down. In the long run, everyone's consensus seems to be that they're bullish, and we wanted to show you how you can utilize options to leverage that. And I will talk about one more thing, because I see a few different questions about this. I'm going to go back to BMO to answer this question. And the question was, why not buy out of the money options? Because they're cheap. And this is really kind of one of the fallacies of buying these out of the money call options, because when I'm looking at this let's go out to January again. I was buying these $66 call options that cost $8.40. This gives me a break-even price of $74.40. So the stock has to move about $6–7 to the upside for me to break even on this particular trade. Now, some people were asking, well, why not buy an out of the money option? They're much cheaper. So let's say I buy the $76 option, it costs $4.30. Now that sounds really cheap, right? So here, $66.83, $4.30, which implies only a 6%. That sounds really cheap, right? But look at the break-even price. The break-even price now is $80. That's just the break-even. So you have to ask yourself, by January 2021, do I think the market's going to be above $80? And maybe your answer is yes. But remember, $80 is just the break-even price, which means that if the stock is at $85, and let's compare this, let's compare these two side by side. And I think this is a really good use of options play, because options play is one of the few places that really allows you to compare different strategies side by side. So what if I buy the $66 call versus the $76 call? And you can say, well, let's say by the end of Q3, right? So the beginning of Q4. Let's say, where do you think the markets can go? Maybe you think the markets will be at $80. So if the market's at $80, notice how the returns here are roughly the same. Now that's a pretty big move to the upside, right? But if the market moves less than that, that's really where these out of the money call options will underperform. So if you really get a very big move to the upside, yes, these out of the money options will outperform. But if you get a move that isn't as strong, these out of the money options will underperform, even though they're really cheap. So cheap doesn't necessarily mean good. A lot of times people equate cheap as good. Cheap is not always good because it requires a much bigger move in order for you to be profitable. And a lot of people, will ask me about probability of profit. What you'll also notice is that the probability of profit at out of the money options will also decrease substantially. So here I only have a 23% probability of profit versus here I have a 31% probability of profit. So that's one of the reasons that buying an at the money call option many times is better, or even an in the money call option, because let's take this example to an extreme level. Let's say the markets just stay flat, right? What you really want to know is how much of your investment will you actually lose. And this is really where, even though an in the money option costs substantially more, you're not actually losing much more, even if the stock stays exactly where it is, versus the out of the money options, you will lose everything in terms of what you can purchase. So that's just a review of how you can take what we've learned over the last few weeks and an idea as far as how you can apply them to the current markets that we're currently in. So I hope that this was useful for many of you that are, starting to explore options, many of you that are already trading options, to give you some ideas as to how to go about looking at some of these names for your trading. So at this point, I really hope that this was useful for you guys. And so what I'll do is I'll open this up for Q&A. If anyone has any questions for any of the things that we just discussed here, this is really allowing you to, I want to give everyone an opportunity to take a look at how to look at the option markets for your portfolio. And I really want to provide, an opportunity also for some of you that have some questions to be able to answer, to ask some questions for, the things that we've applied here, whether it's about buying or selling options, whether it's, anything that we've learned over the last few weeks or anything we discussed here today. Please type them into the chat window and I'll try to answer as many questions as I have time for here today. Oh, and sorry, I know I jumped out from Sucor. So let's take a look at Sucor here. So Sucor, I'll just do one more example before we jump over to QA. Sucor is trading at $18.62. And let's just look at a bullish view going out to January, $4.20 roughly, which is a 22%. So still pretty expensive. Now, I'm surprised that energy stocks is up 13% on a day where oil still continuing to move lower, but maybe that shows you a little bit just about, how oversold some of these stocks are. They are trading at, substantially higher dividend yields than the banks. But again, I think that those dividends are going to be cut in the next couple of quarters, or perhaps even the next couple of months. But so there's a huge amount of risk to taking these types of energy trades. I don't know how much more upside you see on these energy stocks. I certainly do not personally see a lot more upside, but for those of you that are willing to take on that risk, what you can do is you can buy these longer dated call options. see if you can sell some short-term options against it. Maybe in the short run, you think that the stock will stay below maybe $21, $22 in the next couple of weeks, collect roughly 38 cents, which offsets roughly 10% of these long-term calls. The only thing is that if the stock does go above $22, then you won't make any funds, you won't make any additional profits in the next few weeks. So that's the risk that you take when you're trading these types of calendar strategies versus if you're just outright buying that call option. But it's really important to understand your risks before you go ahead and place that trade. So let's take a look at some of the questions here. Francoise, is it early to reinvest in the markets, or should we play our positions more like short-term trading? I think you can do both, to be perfectly honest. I don't think that it's, like I said, I made a case for BMO purely based off of the banks that are basically trading at book value. Rarely do we really see banks trade below book value. So, and the fact that you have the Canadian government stepping in with fiscal and monetary policy to support these banks, that was my fundamental thesis as to why I think these are, relative bottoms for these types of stocks. Now, again, this is based on the data that we have here today, right? Maybe things get progressively worse in the next few months, and I may have to reassess my views on that. But that's why I'm utilizing options to take my long-term bullish view, because I want to express my view in a way that I have limited risk. No matter what happens, I'm risking roughly, 15, 20% of the underlying stock price. In the BMO example before, I was risking roughly 13% of the underlying stock price. So even if the banks go to zero, I'm still only risking 13% of BMO. So I'm willing to take some risks and start looking at some longer term views here for stocks like some of the Canadian banks. But maybe for those of you that think there's further downside, maybe you just might want to wait a couple of weeks before you enter this. This was more of an example rather than saying, here's what you should do right now. And well, actually, this what the point of this webinar is not telling you this is what you should do. The point of this webinar is to show you how you can play this if you're ready to go, take a long-term bullish view on certain sectors such as the Canadian banks. Carlos is saying, are there Greeks to indicate how expensive it is in your Excel calcs? So Greeks do not tell you whether something's expensive or not. Implied volatility tells you how expensive something is. So here, as you can see, BMO's implied volatility is 51%. I think BMO's normal implied volatility is probably in the 12 to 15% range. Now it's trading at 50%. That's why I said that if you looked at this option a few months ago, instead of being 13%, it probably would have been 5% of the underlying stock price. So things have gotten substantially more expensive, but the Greeks do not tell you how expensive something is. But just taking the price of an option divided by the stock price just gives you a quick and dirty way to get a sense for how expensive an option is. Is an IV or HV a better measure of whether an option is cheap or expensive? Sure, it absolutely is, right? So implied volatility is this gold standard of how do you measure whether something's cheap or expensive. But that gets into a term that we haven't discussed here before, and that's why I didn't want to throw more new terms into a webinar where we didn't cover that. And I wanted to just use a quick and dirty way that anyone, even if you know nothing about implied or historical volatility or how to calculate it, you can still get a very quick sense for whether something's cheap or expensive. And many times when we're trading, we don't necessarily have the time to process, whether, something's trading at 50% vol and normally trades at 12 vol. What does that look like? Many times professionals, what we do is we just take a look at, well, how much is a call option with respect to the underlying stock price? That gives us a very quick and dirty way to say, well, are these cheap or expensive? Right now, pretty much everything is expensive. There's nothing that's cheap anymore, right? There's really no, when markets are these volatile, nothing is cheap anymore. So, and nothing is really expensive anymore either, I'll be honest, because, as you can see in many of the names that we just saw, yes, you're paying 25% of the underlying stock price just to take a call option, but those stocks are up 13% today. So, is 25% still expensive? It's hard to say, right? I would argue that it's not, that I would still pay 25% because I think the stock might maybe move 30% in the next month. So cheaper and expensive is very relative terms. And many times, professional traders, what we like to do is just a quick and dirty, what is the option price with respect to the stock price? That gives a sense for how much are we risking. Implied volatility doesn't tell us how much are we risking. 50% vol doesn't tell me that I'm risking 13% on the underlying stock price. Sometimes it's better to think in terms of risk rather than implied volatility. So I hope that answered your question, Chris. Straddle strategies are only possible on cash accounts, not registered. Is there any way around this? I don't believe there's any way around the registered account rules as far as I know. Diagonal call and TD score 142, but no profit. I'm not sure what you mean by no profit, Boris. If you don't mind clarifying, I'm happy to take a look at it. Debbie saying, after banks, what's the next most liquid category? I would probably say some of the telecoms, maybe some of the discretionary names, but in Canada, I would say banks are really at this point, the most liquid options to trade at the moment. If you're right a call or put, do you have to hold until expiration? So with any call or put, whether you're buying or selling, you never have to hold until expiration. Every single option that you either buy or sell, you can close out before expiration. If you bought it, you just sell it. If you sold it, you just buy it back. You can close any option prior to expiration. Where do I find the info on whether the option you showed are American or European styles? So as far as I know, all options in Canada are American style, with the exception of some of the index options, which are European style. But even though there are European options, I would never exercise an option early, even though they're American options, because you can make more money selling the option rather than exercising it. So even though most of the options you trade are American style, I would never, ever exercise early. I would simply sell the option because you'll be able to realize a higher profit by selling the option than exercising the option. Is there any Canadian ETF that has options similar to SPY that has several expirations in a week? Not that I'm aware of. Well, I'm saying there isn't. XIU is going to be the one that has the most frequent in terms of weekly options expirations. SPY, even in the United States, SPY is in a category of its own. There's no other options in the US other than SPY that has multiple expirations in a week. Please comment on how liquid the Canadian option market is. So it depends on whether you're trading a Canadian stock, a Canadian company or a duly listed Canadian company. I tend to find that the Canadian banks are more liquid than on the Canadian markets than on the US market. So if you trade BMO in Canada, it's going to be more liquid than trading BMO in the United States. So duly listed Canadian banks are going to be more liquid in Canada, generally. They are more liquid in Canada than they are in the US. What strategy works better for high dividend paying stocks, whether we buy a put or a call? So high dividend paying stocks, put options are going to be more expensive because as the put buyer, you are effectively paying that dividend to the put seller. It's calculated into the price of that put option. So buying puts on a high dividend stock is very, very expensive because you are effectively paying that dividend. Is there a Canadian ETF that has, I've already answered that question. Given the increased curve of COVID-19 rates, what is your overall thoughts on TSX market in the next 3 to 6 months? So Jason, I don't think the increase in COVID is the concern here, because we know that COVID is going to increase. That's not an unknown. The unknown is really how long is the recovery period going to be, right? So we have China as a template in terms of how long that recovery is going to be. That seems to be roughly 60 days from the lockdown period. You can start opening things up, but that's in a very draconian measure, right? When you really are able to lock everything down. Italy, I think, is our next best template of some of our democratic developed countries, meaning how long is it going to take Italy to go from lockdown, which is, let's just call it March 1st, March 5th in Italy, to when they open up. So that's still potentially another at least 30 days away, if not potentially a little longer. And that's really the data that we need to give us a sense. That is where I think the downside risks lie, because a lot of the data that we're currently looking at, a lot of the consensus we're looking at, is suggesting that that 60 to 90-day window is when we can start returning back to normal. But maybe that's not the case. Maybe if we don't lock down as much as China did, that maybe it takes 120 days to get back to normal. You know, that's the downside risk that I see in the markets in the next couple of months. Unfortunately, that data is going to kind of trickle in. That data is not going to just kind of hit us very suddenly. So that's why I don't see, you know, the same type of panic selling going forward as we did during this sell-off here, because this sell-off here was really due to, number one, just a huge number of uncertainties. You know, right now we have a lot of bad news, but they're not as uncertain. So I would say uncertainty is far worse than bad news. And number two, part of what caused the severity of that sell-off was the lack of liquidity. And now we have central banks around the world that have stepped in to provide liquidity. And that also, I think, was going to ease, you know, any further downside that, you know, if we do have bad data coming out of Italy, that it takes longer for them to get back to normal. In the US, you know, being between US and Italy, I think those are the two countries that are really paying attention to. If those two countries take substantially longer to get back on their feet, that news is going to more or less trickle in day to day rather than cause a severe panic sell-off, and liquidity is substantially better. So I don't anticipate that if we do get further downside that it's going to be in the same type of panic mode. It'll be more of a, I would say, orderly down move to the downside. So that's my views as to how to look at the coronavirus data going forward. If we had sold puts before the market meltdown, this is a really good question because a lot of people are in this situation and now have higher prices to buy back. Would you mitigate April? So one of the things that you can do is you can try to roll those positions, because a short put at this point is similar to a cover call. You know, from a risk profile perspective, it really just depends on where you think the markets will be. You know, if you think the market's going to recover slowly, you can continuously roll your puts lower to, you know, and continue to collect premium. But I will say that if your puts don't expire until May or June, you want to hold on to those puts for now. I don't think you necessarily want to buy them back right now. Would it be better to buy the BMO stock plus a protective put and sell a call? This way you get a dividend also. That certainly is one way that you can play this. I will say be careful about selling cover calls in this market. I don't know if you already own BMO stock, because if you sell a call below your cost basis, you could end up selling it at a loss. That's my only risk to that strategy. But as long as you're familiar with that risk, I certainly think that buying the BMO stock, the only thing is that buying that protective put is probably going to cost you substantially more premium than selling that call option is going to collect. And when you buy that put, you're effectively paying the dividend by buying that put. So you lose the advantage of getting paid the dividend. So I hear your point, Alan, but the cost of that dividend is already already implied in the cost of that put option. So you kind of negated the dividend payment by buying that put. Would you trade options on XFN? The spread looks very high. I'm not familiar with that name, so just by the fact that I'm not even familiar with it probably means, I think this is another S&P TSX 60 cap financials index. Okay, so this is a subset of the TSX 60. Yeah, so if you look at the put option, 111 by 283, that is a very, very sizable you know, spread. I would generally be very, very careful. I would place my orders at the midpoint. If I don't get filled at the midpoint, I wouldn't chase this. You know, it's difficult to trade these and get in and out. Someone's asking about a weekly liquidity list on Canadian stocks. We are currently working on that, so I hope to be able to publish that for you guys later this week. Currently, what we do is we started tracking liquidity in the U.S. symbols, because, you know, we normally say that there's about 400 to 500 liquid symbols in the U.S. As of last Friday, that list shrunk down to just about 100. And a lot of requests came in and see if we can do the same thing for Canadian stocks. So we are working on that, and I hope to get that out to you later this week. Buy TD January 56 call, sell the April no profit. Why? I'm not sure what you mean by no profit. That certainly sounds like that would be profitable. Buy the $56 call, sell the $62 call against it. So buying the January $56 call, selling the April 62. And selling the April 62 calls, there certainly would be profit, especially in the short run before expiration. So, you know, by April 17th, which is the expiration date, what you want is the stock to be below 62. As long as it's below 62, that's when you're going to get max profit. Your max profit is going to be at 62, which you're looking at about a $529 profit by April 17th. If the stock is below $62 is when you're profitable. If you go substantially above 62, that's when you will start you know, making less and less money, because the short call will start offsetting the gains of your long call. Carlo, in the example you showed before, you're buying a long call and sell a near-term call. Do the shares get assigned if they move above the strike price? So if you get short, if you do not buy back the 62, so let's say by April 17th, the stock is above 62. Let's say it's at 63.5. What you have to do is you have to buy back this short call. Otherwise, what will happen is you'll be effectively short the stock. Now, that will offset against a long call that you have, but you will be effectively short that stock on Monday. So when you're trading these calendars or diagonals, it's really important that on the first expiration date, you check on Friday whether the stock is above 62 or below. If it's above, you need to buy back this call option before you sell another one. So great question, Carlo. Joe is saying, I want to be long on Canadian banks. Any downside to buying a put option for January 20 and selling calls until then? Buying a put option and selling calls until then. So buying puts and selling calls is a synthetic short position. So that would be the exact opposite of what you want. I think what you mean perhaps is selling puts and buying calls, Joe. That would be a synthetic long. So as you can see, look at buying the stock, right? 57.23. What you're suggesting is something that looks like this. But that would require selling a put and buying a call, not buying a put and selling a call. Because if you bought a call and sold a call, that would be a short synthetic stock position. But this is certainly absolutely a strategy that many traders do. Many traders, what they'll do is they'll actually buy a slightly out of the money call option and sell a slightly out of the money put option, because what you have is a synthetic position that looks very similar, but you trade it at virtually zero cost, and your margin requirement on selling an out of the money put option is a little lower. So this is what we call a risk reversal strategy that I would say it's a strategy that's more traded on the institutional markets, but you know, this is the type of risk profiles you want to sell a put, buy a call if you want to go long the stock. What are you using to? This is TradingView. This is a publicly available, you know, site that anyone can use. They provide charting for global stocks and indices. So for those of you that like to trade, you know, FX and look at all the rates, you know, Canadian exchange rates, interest rates, everything, it's available through a website called TradingView.com. How wide of a spread would you consider to pass on an options trade? So, you know, when a single option where the spread here is greater than, I would say, 20 to 25% of the cost of the midpoint. So here, as you can see, $1.05 by $1.23, that's 18 cents. 18 cents is roughly a little under, is what, 7% of the mid price. You know, I would say when you exceed 20% of the mid price, that's when I think the spreads are too high. Laurent is saying, considering that the options are currently very expensive, what strategy would you suggest before the options get back to average. The strategy that I just showed you, buying the long-term options, because the long-term options are still relatively reasonably priced from an implied volatility perspective. And then what you want to do is you want to sell really expensive options against it. That's the way that you can maximize the offset, if you will, of selling really expensive options and buying relatively cheaper options by going further out in time. That's how I would trade the current market environment. I believe that's all the questions. I'm not following the relevance of knowing percentage of premium versus the underlying stock price. If the contract moves in the money, then why does it matter? Because in the money has nothing to do with it, because you have to look at your break-even price. Your break-even price is really what determines whether or not you're profitable. Just because something's in the money, you would still lose money on the trade. So if you bought in this particular case, let's say you buy a $60 call option, once it's in the money, you still lose money. So if the stock goes to $60 by January, you've lost $5.10. You need to know what is the break-even price, which is determined by the price of the option here, $5.10. So the break-even price is $65.10. That's why it's important. What factors do you look at to consider options are cheap? Again, very quick and dirty way is just look at the price of the at-the-money option with respect to the price of the underlying stock. You know, as you can see, look at how wide this ranges. Some of them are in the high 20s. Some of them are in the 8 to 8%. So CM options are significantly cheaper than CNQ or CG or Sucor. That's how I can tell what's cheap and what's expensive. What strategy do you look at when you want max downside protection? I guess that really depends on what you mean by max downside protection. Max downside on a stock that you own? It really just depends on what you mean by max downside. If you do a calendar spread and you get assigned, do you have to buy the stock, or does your long-term call use as an offset? If you do get assigned, you can exercise your long-term call, but I would just close out the short position that you end up in, because if you exercise your long call, you're gonna lose all the time value on that long call, and I don't recommend you to do that. If you own a stock or ETF already, would you generally recommend a long call collar strategy? Again, I think the problem with a long call collar strategy is that when you buy that put, you're effectively paying the dividend. So I think that unless you think there's going to be significant further downside, if you think there's going to be significant further downside, I would argue that you should just sell the stock and buy it back later when you think it's going to, when it has bottomed, right? Because buying put options are so expensive. And when you sell calls against it, you're not going to be able to offset the cost of those long puts. So I find that the collar strategy, in my opinion, is difficult to do. If you think there's going to be further downside, I think you're better off selling the stock, waiting for the markets to continue moving lower, and hopefully buying that stock at a lower price. Carlos saying the simulation tool on the right is very clever, very handy. Wish I knew about this before the meltdown. Carlo, as you know, absolutely. I hope that you find the simulation tool useful. I'm sorry that you didn't get to see it before the meltdown, but I'm glad that we're able to show you this during the meltdown so that because I will say that in these extreme examples, this is the best time to actually see the power of options, because when things are really quiet, sometimes it's difficult to see because the premiums are so low that sometimes some of the strategies actually don't make a lot of sense that normally that we teach, like a calendar or diagonal. It just doesn't make sense when things are really, really quiet. But when things are really volatile, that's when these strategies make a lot more sense. So, we will cover some of the strategies that are going to be useful when things are a little bit more quieter. Those are some of the topics we'll cover in April. So we really hope to see some of you there for that. How do I access OptionsPlay on the TSX? Great question. So just again, to recap, you can register here at optionsplay.com/TMX. It's completely free of charge for Canadian residents to be able to access OptionsPlay Canada. Eventually, the implied volatility will drop. Will this affect long-term options, and by how much?
The answer is it's going to affect the long-term options less, because look at this. The long-term options are trading at 35% vol versus the May options are trading at 48% vol. So even if you get a crush in implied volatility, it's going to affect these short-dated options far more. And that's why it makes sense right now to sell these short-dated options, because as volatility comes down, it's going to benefit the short-term options that you're selling, and it's not going to affect the long-term options that you're buying as much. And that's really why, again, the calendars and diagonals make so much sense in these types of really volatile environments, especially when things are starting to stabilize and you expect that volatility to come down. You're really utilizing the benefit of both of this volatility crush. Are the bid-ask spreads on OptionsPlay? These are delayed by 20 minutes. In the free version that you have access to in OptionsPlay Canada, these are delayed quotes. So when you're ready to execute them, I recommend that you actually log into your tool to be able to log into your brokerage firm to be able to look at the real-time quotes. One thing I do want to show you guys is the trading simulator. For many of you that are new to options trading, there is a trading simulator on the Montreal Exchange website, which I will post a link to everyone here in the window. This simulator allows you to actually take some of the strategies that we showed you here today and actually execute them and see how they actually perform. And you can type them into your simulator. So some of the trades that we were looking at here today, you can trade them and actually see how they would perform. So let's take a look. We can actually do that real quick with the BMO. Actually, I don't know that I can enter this as a single strategy, but what I can do is I can look at a call option and then trade them separately. So before I was looking at the January $66 call option. I can buy to open. It's trading at 820 by 860. So I can put in a limit order at maybe $8.40. And then what I can do at the same time is I can sell a April $72 call option. Whoops, sell to open. This is trading at $1 by $1.20. Maybe I'll put that in for $1.10. And what you can do is you can go to your order manager and see your option orders here. And especially for those of you that are brand new to options trading, this is a great way to go about really learning how to trade and trying trades out before you execute them in your actual brokerage account. This is, again, a free tool available from the Montreal Exchange. I actually wanted to use this earlier, but unfortunately I actually spent so much time on OptionsPlay, I didn't get a chance to go through this with you guys. But this is a very valuable tool for you, especially for those of you that are brand new to options trading, to practice trading. You know, I get a lot of questions about where can you get a practice account. And for those of you that trade US options, there actually there aren't any simulators that you can use for the US markets, but in the Canada, you can use this TMX trading simulator provided by the Montreal Exchange that allows you to really practice trades and see how they perform before you execute them into your brokerage account. Given the high volatility recently, would you recommend selling weekly options? I would only sell weekly options in this type of market environment. And selling weekly options are a great way to utilize or take advantage of the high volatility. Just be careful with what type of option strategies you're trading. If you're selling puts, make sure you understand the risk of selling puts, meaning they should only be on stocks that you wish to purchase. Selling cover calls is another popular strategy in this particular, especially for stocks that you own. Just be careful that when you sell those call options, you are aware that you are obligating yourself to sell your stock at that strike price. So be aware of where your cost base is and where you're selling those call options. But those are great. Those are strategies that are ideal for this type of market environment. Is there a tutorial on how to use the OptionsPlay platform? Yes. So we actually have a YouTube channel. Let me pull that up real quick. We actually have the YouTube channel where we have a tutorial for you, and I just posted a link to everyone here into the chat window. There's we have a guide to how to utilize OptionsPlay when you go to that YouTube channel, and I highly recommend that you subscribe to us on OptionsPlay on YouTube, because then every single time we post a new course, like we did a few weeks ago and last week, you get a notification. Even if you're not able to attend our tutorials or our webinars live, you'll be able to get a notification and see them as soon as we post them to YouTube. So with that, that covers everything that I wanted to go over here today, and looks like that's the end of the questions here today. I just want to again thank everyone for taking the time out here this afternoon. And again, I'm going to post the link to the simulator again into the chat window for those of you that want to sign up. It's again free of charge to everyone. It allows you to put in your own trades, track them, see how you do. You get a starting value of $100,000 in your portfolio, and you can see how it performs over time. So thank you so much. I hope you guys stay safe. Hopefully some of you that are staying at home, I hope that you're able to get back, I hope things are able to get back to normal sooner than later. I know that this is a trying time for everyone. And I know that especially for those of you that are investing, some of you may have taken some pretty large hits in your portfolio. I hope that this was useful in helping you understand how to position for your portfolios going forward, especially in this high volatility, how to potentially use them to your advantage. So with that, thank you so much. I hope you guys have a great afternoon. And again, I reiterate, we're doing a very special virtual options education day for you on April 27th. We have 5 speakers lined up. We're all going to show you how we're going to apply different strategies using the live markets. We're going to be using the simulator and showing you how to access the how we trade the markets using the simulator. And you can register using the link that I just posted into that chat window. So thank you so much. I hope you guys have a great afternoon, and I'll see you guys in next week, actually. So have a great afternoon, and I'll send you guys a recording as soon as we're done here today.